Brandon, Jeff. Nice to meet you too. Dominic, Jeff, nice to meet you. Chuck, Jeff, nice to meet you. Sean, sorry.
So yeah, I think you're gonna set it right on top.
Yeah.
Do that deal. Make sure that's working and stuff, and take your time, obviously. And then whenever you're ready, you can just let me know, and I'm sure they'll need a minute. And as soon as you guys start going, we'll.
You good? I'm good too. Once it gets ready.
You guys are good whenever, and I'll start the clock whenever you start talking. So.
All right. Thank you, ladies and gentlemen, for joining us for our presentation on Whirlpool Corporation. My name is Brandon Clements, and presenting with me today we have Sean Canning and Dominic Curtis. Whirlpool is the largest manufacturer and marketer of appliances in the world, and they're located in Benton Harbor, Michigan, touting the popular brands such as Maytag, KitchenAid, and JennAir, to name a few. Their market cap is $13 billion, with institutional ownership at 92.5%, and they are currently trading at 15 times earnings. After an extensive analysis, we are issuing a buy recommendation with a target price of $197, representing a 13.5% upside. Three main catalysts for our investment decision include Whirlpool's leading market share in the US, their proven track record of implementing acquisitions successfully, and a promising global economic outlook.
As you can see on the graph behind me, none of Whirlpool's product categories constitutes a demanding portion of overall sales. And geographically, North America, one of Whirlpool's 4 operating regions, constitutes half of Whirlpool's overall sales. And as Brandon's flipping through these graphs, you can see that Whirlpool has a very diverse manufacturing base in each of the regions in which it operates. This allows Whirlpool to have a true presence in each region and to manufacture and market products that are suitable to each region. Looking at organic sales growth in each region, net of acquisitions and currency exchange, you can see that sales in Latin America and Asia have really grown the past 12 years. And factoring back in acquisitions, especially the acquisitions of Jefe Sanyo, a Chinese home appliance manufacturer and distributor, and Indeset, an Italian home appliance manufacturer, has really bolstered sales in those respective regions.
The home appliance manufacturing industry is a highly competitive and fragmented industry, with large multinational players as well as smaller regional firms. Following the 2007-2008 recession, many consumers postponed purchases of home appliances due to the state of the economy. With the U.S. Consumer Sentiment Index near its post-recession high, we expect that pent-up demand to provide a boost to home appliance sales going forward. One of the biggest challenges the industry faces is the growing demand for technology integrated into home appliances. We believe that the ability to integrate successfully and find that balance between gimmicky innovation and practicality is going to be a key ingredient in determining who's successful in the coming years. Whirlpool is undoubtedly challenged in this facet as it's going against the likes of Samsung, Haier, and LG, all of whom have technological backgrounds that extend well beyond the home appliance industry. Therefore, it is going to be paramount for Whirlpool to leverage a strong financial balance sheet in order to innovate on pace with its competitors. The biggest opportunity we see for Whirlpool is the growing demand in emerging economies. According to a study done by Credit Suisse, in 2015, 100 million households entered the global middle class from emerging economies. And if you look at the chart on the right-hand side, you can just see the disparity between urbanization rates in developed and developing economies, indicating that there's a lot of untapped demand in these regions. Just to give you a sense of how much this impacts Whirlpool's business, in India, 69% of the population lives in rural areas. Yet of Whirlpool India's sales, only 10% comes from the rural regions. So as these large demographics of people move to cities, gain access to electricity, running water, and see rising wages, the home appliance industry sales should benefit. And one of the ways we see Whirlpool capitalize on this new phenomenon is through the acquisition and going out and targeting firms in these regions, gaining access to the valuable distribution channels, and then using those to leverage its current portfolio of brands.
The first thing we'll look at when analyzing Whirlpool's financials is their cash flow. Whirlpool's cash flow from operations has increased at a 5-year compounded annual growth rate of 23%. This demonstrates that although Whirlpool is a mature company, they're still finding areas for growth. The nearly $2.5 billion from investing in 2014 was due to the acquisitions of Indeset and Hefe Sanyo, as Sean previously mentioned. These were instrumental in helping Whirlpool achieve economies of scope abroad. Lastly, if Whirlpool is able to generate these strong cash flows, it will allow for flexibility within their operations and facilitate M&A activity moving forward. With the acquisition of Indeset, their liquidity decreased as the current ratio dipped below 1. One way to combat this was by increasing their tie ratio from 4.2 times in 2011 to 8.6 times in 2015. Additionally, they were able to decrease their cash conversion cycle from 30 days in 2006 to 7 days in 2015. This was due to favorable negotiations on behalf of Whirlpool, and they've been able to increase their days payable by 63% over that 10-year period. Looking at the DuPont analysis, there are two main driving factors that are influencing the ROE. The first is the profit margin, which is relying on a strong gross margin. Looking at the gross margin index, we see the year-over-year growth that Whirlpool has demonstrated. We believe this trend will continue to increase into the future as the synergies from the Indeset and Hefe Sanyo acquisitions are fully realized. The second thing that affects ROE is the equity multiplier. The more leverage, the higher the ROE. Fortunately for Whirlpool, their management team has demonstrated the expertise necessary to finance with debt, which will benefit the return on equity moving forward. Lastly, Whirlpool returns cash to its shareholders in two ways. The first is through dividends. They pay a 2.3% dividend yield and have been increasing their dividends since 1995. Their 5-year compounded annual growth rate for dividends is 16.11%. Another way that they return cash is through share repurchases. In 2016, they authorized a $1 billion share repurchase program. Now for our valuation.
We utilize the discounted free cash flow firm method to value Whirlpool with a target price of $197 per share. One of the most important inputs into our model is sales growth. In order to forecast sales growth, we looked at some key factors that we thought might have a relationship with Whirlpool's sales. And we regressed those factors historically to see if there was a relationship, and if so, how strong the relationship was. For the North American region, we used historical growth rate for the region, as well as projected US GDP growth rate and projected growth rate in US housing starts. For the EMEA and Latin American regions, we used historical growth rates for both regions respectively, as well as projected GDP growth rate of the European Union for the EMEA region, and projected GDP growth rate of Brazil for the Latin American region. For the Asian market, we assumed they were still in the super growth period, and we could take their 5-year 9.4% historical growth rate and carry it on through 2020. In aggregate, we forecast Whirlpool sales grow at a pace of 4.5% per year. In calculating the weighted average cost of capital, we use the 10-year US Treasury bond yield as the risk-free rate. And to fully encompass the global nature of Whirlpool's business, we took equity risk premiums from various regions, and we weighted them proportionally to the amount of sales Whirlpool does in those regions. For the beta, we calculated it based off of weekly returns over the past year of the S&P 500 versus that of Whirlpool stock. We arrived at a weighted average cost of capital of just under 11%. We then chose to calculate a second weighted average cost of capital, with the only difference being a beta of 1, making the assumption that in the long run, Whirlpool stock correlate perfectly with the market. We took this lower weighted average cost of capital to discount the terminal value. We forecasted free cash flows through 2020 and calculated a terminal value. We took the summation of those discounted values, added back its current cash position to get Whirlpool's total firm value. We then subtracted the debt to get their implied equity value per share of $197. One of the major limitations with the DCF analysis is its sensitivity to certain inputs. To account for this, we calculated Whirlpool's target price in our model based off a varying range of inputs, both the weighted average cost of capital as well as the long-term growth rate.
As Brandon's cash flow analysis shows, Whirlpool has a very competent and proven management team that is able to guide Whirlpool through a lot of risks, one of them being currency exchange rate risk. It has adversely affected Whirlpool the past couple of years, but they do firmly believe that there will be less of an impact moving forward. Another risk is if they are unable to implement their acquisitions effectively. However, they have stated that the acquisition of Indeset will be complete by the end of 2017. And thirdly, another risk that Whirlpool faces is if it was unable to innovate on pace with its competitors. However, it does have a partnership deal with Amazon to have Alexa be enabled in its smart home appliance line.
Whirlpool released its 2016 fourth quarter earnings, and the stock price fell 8.5% after missing revenue expectations. Whirlpool's management lowered their 2017 guidance, but we still believe that they will be able to outperform relative to their competitors for 3 key reasons. The first being, Whirlpool manufactures in the regions in which it sells, making it resistant to trade war risks. The second, the possibility of future M&A activity is aided by the nearly $1 billion in cash, as well as management's ability to effectively use debt, along with flexibility for future acquisitions. And lastly, pent-up demand in the U.S. housing market will strengthen sales in North America, its largest region. This is due to a revitalized economy that has fully recovered from the 2008 economic downturn. In closing, we would like to reconfirm our buy recommendation with a target price of $197, indicating a 13.5% upside. Thank you, and we welcome any questions.
Nice job, guys. Thank you. I enjoyed it. One of the things that you talked about as a plus was their success in making acquisitions. They've had a couple of notable acquisitions in the last 2-3 years. As you look at their M&A potential going forward, I think what you also cited, we've got kind of an oligopoly effect here where there's a limited number of manufacturers that kind of came up in your orders by forces. So who else is out there? What other strategy would they use on the M&A front that you would look forward to?
Do you want to touch on China and then I'll touch on India?
Sure. So one of the firms, we were looking at regional players. So with an acquisition, we're not expecting Whirlpool to go out and acquire or merge with a huge player in the industry. They actually look to smaller regional firms to get, I guess, more of a name brand in those areas. A couple of the firms that we looked at, one is Gallons. They specialize in mini refrigerators and as well as microwaves. They have about $3 billion in sales, and that is also in China to expand that reach. Another one is Hefe Mailing, and they're the same. They're an appliance manufacturer specializing in refrigerators with about $1 billion in sales. So they're looking for the smaller regional firms, not necessarily a larger acquisition.
And just to add on that, so in India, Rico is a firm that they make small mixers and as well as other small appliances. We're not necessarily stating that Whirlpool's going to go out and part of these specific firms, but these are the type of firms that they're looking for. One of their main reasons for the investment in Hefe Sanya was their distribution channels and their access to rural areas in particular. So what Whirlpool's looking to do with these acquisitions is they're looking to gain access to so they can get their products in front of those consumers and use that to leverage all their portfolio brands.
That is awesome that you guys had an appendix slide anticipating that question. Thanks.
In your DuPont analysis, you talked about leveraging debt as kind of a way to really drive bottom line growth there. As we face the possibility of rising interest rates, do you see that being a challenge maybe, or something that you would look to maybe deleverage?
I think Whirlpool has done an excellent job at managing their debt over time. I don't necessarily think that would be a huge problem if interest rates were to rise. The amount of debt they have is actually, they're less levered than one of their competitors, Electrolux, whose debt to equity is about 0.85. So I think they're in a comfortable position with their debt, and they could afford to possibly take on more debt with even rising interest rates.
And just to even add on to that, when we forecast our financial statements, we target a capital structure between 0.7 and 0.75 for the debt to equity, and that's based off of just looking historically. So this is pre when the economic easing or quantitative easing and all low interest rates. So they've demonstrated in the past that this is kind of their target capital structure, an optimal capital structure, even with interest rates that were higher than they are currently.
So going back to the risk slide here too, guys, one of the risks that we've kind of talked a lot about today is just price risk in the U.S. here from competition entering the market and entering with lower prices than Whirlpool. And you guys didn't really mention that too much. Is that just something you guys don't view as a big concern, or did you guys put any thought behind that?
So with the dumping, so obviously that put a lot of pressure on their margins, but fortunately sanctions have been placed on LG and Samsung for those selling below cost and trying to increase their market share. And even with that pressure, their margin has still increased. From 2014 to 2016, the margin has been able to increase even with that pressure. So we think that over time, with the sanctions on the two companies, that the margins will only see the benefit moving forward with that.
You did something pretty innovative in the valuation that we hadn't seen today, and that is you had a short-term WACC and a long-term WACC where you kind of normalized it for a beta of 1.0. My question is, looking forward, and you look at just North American cycle, which has been just with a vengeance up and down, as you pointed out, over the last 15 years. So what is their normalized beta next 5 or 10 years, and then how does that affect their valuation?
Yeah, so I think what we did there, so we took the beta just based off of current market conditions, and we thought that that was the best beta to use for the next 5 years. Our logic behind using the smaller weighted average cost of capital due to the lower beta of 1 was just in the long run, we think that the unpredictability and how they're going to react with the market is it was safer to use that, and it's actually recommended by Oswald Doran in his valuation when you go past the certain extended period where you can value out the company.
All right.
Yeah, one of the other things you guys mentioned earlier in the presentation too, you guys talked about technology innovation as being key to their growth. What are some examples you guys are thinking of? We were joking about a few things this morning before we got here too, but what have would you put together on that?
As far as stuff they've done already?
Or anything in the
Okay.
pipeline too.
Yeah, so they have, for instance, they have a microwave, or excuse me, an oven, where you can scan the barcode of the package of whatever meal you're making. That way, maybe if you're going from convection for 20 minutes to some other setting, you don't have to do it manually. The oven will actually do it for you. And then there's a lot of it's more stuff where it's going to be more eco-friendly. For instance, if you have a washer and you have a load of laundry in it, but you know you're going to leave, you can actually set that in your phone to make it an eco-friendly, where it's a slower process, but it will use less water. And I know, Sean, you want to touch on some more?
Yeah, they're also going into like adjacent products such as the Zero Food Recycler. This can take a week's worth of a family's food waste, and in one night it can turn it into usable compost. So year round, even when it's snowing outside or whatever, you can still use this food recycler to make compost, and so it's also eco-friendly and reduces waste.
And I think just one thing to highlight from both of those points is they're looking to save the consumer money in the long run with the eco-friendly stuff compared to their competitors, which it seems like they're kind of just adding like not necessarily, I guess, unnecessary things to their appliances. So Whirlpool prides himself on, I guess, the efficiency and saving the consumer money.
It sounded like with regards to hedging, you guys had decided that management was making a good decision, not increasing their hedging that they were doing across the different growth regions globally. Could you elaborate on maybe what you looked at as far as maybe Latin America or Asia and spots where they've had growth in sales but been hurt by currency exchange?
Yeah, so if we look at just, let's backtrack to the 2014 area. So when oil prices began to decrease, the Russian ruble depreciated significantly in value, where Whirlpool has a large presence there. And then also you had the economic and political turmoil in Brazil affecting the Brazilian real. And then also just this past year in 2016, the Brexit had a big impact on the Great British Pound, where Whirlpool does 15% of sales. And just more recently, following the surprise election of Donald Trump, the Mexican peso was hurt. So these are a lot of kind of events that we don't foresee happening again in the future. And if you look at a lot of those currencies, they have bounced back since those events. And the global outlook, we think, looks a lot more promising than the past.
On your income assumption, or income statement assumptions, as you went by region, you pretty much used the region GDP. I like the fact that you put the correlation, showed how effective it is, that you didn't use the ones where the correlations were negative. That was great. Did you look at more market competitive company specific factors for your region sales other than just the change in GDP? For example, Brazil definitely being maybe a case in point of lots of other factors going on there.
Yeah, do you want to go to the North America subject?
Yeah.
So due to just kind of a lack of, let's say, data that we could find a relationship on, North America was the only region where we could factor in something like housing starts, just because of, one, the availability of data, also as well as the availability of projected data. So we needed something that we could not only identify your sales growth as having a relationship with, but something that we could take a, a confident projection going forward. So this was actually, U.S. housing starts projected by the United States Federal Reserve. So that's something that we're comfortable with using that as projection. I think a lot of other things either didn't have a relationship or we couldn't accurately project that.
You mentioned that, and I like the specificity of that. You gave the statistic that 82% of U.S. sales are manufactured in the U.S. If there's a border tax adjustment, can Whirlpool move enough of that Mexican, I presume, for the U.S. production to the U.S. plant? Do they have the capacity, or what do they do in that situation?
Yeah, so I think the big takeaway on this is relative to their competitors, Whirlpool is wholly a U.S. manufacturer, and they pride themselves on that. They have 8 manufacturing plants in the U.S., and we've even seen like LG and Samsung wanting to come over to the U.S. just based on these proposed laws that will be implemented, and that's going to be an extreme capital expenditure for their competitors. And fortunately, Whirlpool already has capabilities in the U.S., and I think that they'll be made kind of like a poster child for U.S. manufacturing, which can only benefit them. So.
Yeah, and just to add on to that, so if you look at their relative to their competitors, so you have companies like Samsung and LG that just got caught for dumping, and based off the new administration's policies and rhetoric so far, it seems that they're going to reward a company like Whirlpool, who's really the only primary U.S. manufacturer, and they're going to reward them and maybe punish some of their competitors that he just recently got caught on doing activities like that.
Nice job, guys.
Thanks.